So I was giving an example of the other company that went down, which is Kun Foods. And Kun Foods, well, I think it was just a bad investment idea, because I don't know what problem they were even solving. There was non-existent issue. You see, when you're starting a business, you should ask yourself whether you are giving a solution to any problem that is existing. So Kun Food was a cloud kitchen, which was very expensive, because a plate, the cheapest plate was going, I think, for 350 shillings. So you can imagine they are competing with a Mama Kibanda who can sell the same food at 70 bob. Or let's say the highest a Mama Kibanda will sell you, let's say, is 120 shillings. Let us even talk of half the price, 175. So they were competing, I think, in the wrong environment. They had actually invested a lot of money in doing the survey and the startup, but because they were talking of a capital of 1 million USD. 1 million USD is like 117 millions Kenyan shillings. I remember because they shut on June 22, 2022. The proprietor or the owner, this man, Robin Recht, is a French man. He just tweet, it's a sad day for Kun Food, for Kun. So not even, he just said, sad day, Kun closed today. Very few words, only 5 words. And this was said in a virtual meeting. So they had ran out of cash completely, and they hadn't seen the financial distress. If you have a venture where you have invested 117 million, that's not a small venture, isn't it? So if anything happens, you are supposed to have realized. By the time they were going down, I remember they were vouching for, how do we call them? The venture capitalists, because they wanted to expand their business in other branches in Kenya. And they had already shown indications of being given 4 million USDs. So you can imagine the magnitude of loss that Kun Food could have undergone. Well, we've had many banks going down, but banks normally go down because of the corporate governance issues. A good example is the Equatorio Bank went down. Then we had the, now you can't even note in Kenya, because most banks, when they start getting the financial distress, most of them will either be acquired or sell their stake to other banks, or they rebrand. Good example of the bank that has rebranded is KREP. KREP was acquired by KREP belongs to Chris Kirubi, and it was purchased at a time when there were no interest capping. When Dr. Njoroge joined the central bank, the first thing that he did was to cap all the interest. And this is where the banks were making the abnormal profits, because they were not regulated as such. I remember the first year KREP was purchased, it made a return on investment of 30%. They sold their stake to Access Bank of Nigeria the other day. I think by the time they were selling because they had done a valuation, they were valued at 4.7 billion, because they were acquired at a loss. Access Bank of Nigeria. Access Bank is the biggest bank in Nigeria. It acquired KREP. They were calling themselves Sidian Bank. They had rebranded to Sidian, then it was not working. They ended up selling Sidian Bank to Access Bank. at a cost of 4.3 billion. So they went at a loss of 300 billion. So you are not billion, 300 millions. So you can imagine they had bought it at 2.7. Well, they have made 2 billions, but if you look at the value of the shilling or the value of the time that they have been in operation, then you could say that they have sold their stake at a loss. The other banks are like the Imperial Bank, we had Chase Bank, who are also hit by the interest capping. I think that's why Dr. Njoroge, sometime in 2019, he reviewed the approach and introduced what we call the risk-based regime, where borrowers get same rate based on the risk of the customer and now not the cost of the bank. Again, this means that you cannot extend or you cannot give a credit at a higher rate than your competitors. So again, their freedom is curtailed. Well, these are some of the things that we want, because even our real estate industry shows abnormal performances because of what we call the greater fool theory. You know, we assume that greater fool theory says that at times we buy assets at a higher cost, anticipating we are going to get a greater fool or investor who is willing to give more money. So you can buy a piece of land at Kamakis at 500,000 in the morning, and by evening you sell it at 1 million and make 100% profit. Well, you see, even our real estate market being the fourth biggest contributors of the GDP, the government should ensure that they control what is happening there. Otherwise, you are going to experience a bubble like the one that is happening in Canada. Well, that's a story for another day. So if you ignore the signs of financial distress before it gets out of control, it can be devastating. And in most occasions, once you go below our median mark, which is 1.8, we'll be looking at the Altman Z-Score later on to see how we are able to measure or detect the financial distress. It can be devastating. So a good manager should be able to see the early signs. So this will be advising the strategy of the company, so that if they are caught up in the fix, they'll be having a way out. Now, we have different forms of financial distress. The first one is technical insolvency. And this is a situation where a company is unable to cater for its current obligations. And this is normally temporary. And that is why we normally do the current ratio and the acid test ratio. Being unable to meet your short-term obligation doesn't necessarily mean that you are struggling financially. Could be you have expanded and you've used your reserves or the retained profits in the expansion. Then we have that's why I'm calling it technical, because it is temporary. We have insolvency in bankruptcy, and this is when the liabilities of the company exceed the assets. The case of Egerton University or the Kuhn Foods. I don't know where I've taken my ruler. So it comes in three forms. We have what we call the legal bankruptcy, and this is where the company itself goes to the court of law and to a commercial court and says that we are insolvent or we are bankrupt and we may need a receiver. Then we have the economic failure, and this is where a company's revenue are insufficient to cover for all its costs, including the cost of capital. See, the reason why the owners start a business, no one will start a business, although a business is a risk. You wouldn't start a business if you knew that you are going for losses, isn't it? But because it happens, So such a company can continue operating as long as the creditors are willing to provide capital, and that the shareholders are also willing to receive the below the market returns. But it's also a very serious balance, because even the shareholders, it's either they are going to withhold their investment or they are going to pull out. And then we have the third one, the business failure. And this refers to any business that have terminated its operations as a result of loss to creditors. Good example is the Kun Foods. So a business can also close and be counted as a failure. So when we are talking of the business entity concept, when you start a business and register it, we expect that that business will run for an unforeseeable future. We do not expect that business to close. Closing that business demonstrates a failure, because if the business was performing, no one can close a business that is working or bringing revenue for them. So the costs associated with financial distress are: there are penalties and fines for failure to comply with the terms of the loans. Of course, if you are unable to meet your loan repayment as and when they fall due, the bank will surcharge you the late payment. Then we have the opportunity cost for loss of revenue. So the customers will also tend to move. I don't know whether it's this class I was saying. If you walk in a supermarket, and we've seen our supermarkets also going down, but then they went down because of the what we call the bad supply chain practices. That's why I'm not giving them as an example of financial distress. Them is a different case. So they were unable to manage their inventory. So if you walk in a supermarket, and let's say you wanted to buy 5 items, and you can only get 2 items, I'm very sure if you walk to the next supermarket and get all the items in one shop, that's why it's called a supermarket, you'll never go back to the supermarket where you got only 2 items. So customers will start moving. So the customer loyalty is shift, and this is momentarily what will affect your sales. And the ripple effect is you'll be unable to operate. Then you have failure to invest in profitable projects. Well, depending, actually not all companies are formed for profit making. We have welfare bodies like Kenya Red Cross or the International Red Crescent, where Kenya Red Cross is anchored. So not all companies, but if a company was formed with a goal of project, with a goal of making any profit, I've said once the call close, you can just log in again because we are limited. So we have the cost of hiring. Don't know who has again joined and not on mute. We have that is Altman Z-Score. Anyway, let's go on. Then we have the cost of hiring lawyers in legal suits. Lawyers have to be paid, that's obvious. And then the last one, we have the losses due to, of course, strikes by the motivated labor force. So you've seen the lecturers at Egerton University have downed their tools. So even the little money that they were collecting from the school fees of the students, they won't get it because no student will pay when they are at home. Now we have the signs or the indicators of financial distress firms. The first one is dividend reduction. So the company will not declare either interim or the final, and if they declare, it will be less. Then we have the violation of loan terms, being unable to pay in time, then accumulating losses. By and by, instead of having retained profit, we report a loss, the taxes are deferred. So everyone at the end of the day is like we are owing everyone as the company. Then we have layoffs and retrenchments. So the early signs will be seeing the company doing restructuring or cutting down on branches. if they have branches, let's say in different towns, they convert the branches into what we call the revenue center. If the branch is unable to meet their target, they close down. Then we have very high labor turnover. Employees start moving out. Then top management resignation. Now the managers are the first one to leave because you don't want your image that you have protected for a long time as being the CEO of this company. The moment you realize that this company is showing some indicators of financial distress, most CEOs will move out. They won't wait until they are caught up in the fix. Then I've given the example of the closure of branches. Now, during distress, we have options, and these are the options that the company may exploit. We have what we call the merging with other companies. So if you have a sister company, I'll give an example of, well, mergers that have taken place in this country. When NIC Bank realized that the asset, NIC Bank were in asset finance. So they were lending out the heavy machinery for construction works, for example. They were in asset management. At some point, when they realized that they needed a lot of capitation to do this, they had to merge with CBA and they formed NCBA. Well, the merger has been critiqued by professionals. Well, I have my opinion that I don't want to raise, but I'm saying that most companies will merge because there is strength that they want to benefit from. So, and most of them are financial strength. So if you realize that you are getting weaker financially, you could merge and leverage on the strength of the other company. Then you have issuing new shares to raise more capital. So a company may go out there and issue more shares to expand their capital base. They could dispose of some of the assets, the real assets that they are holding on. Then instead of waiting for them to go down, they can liquidate. They can lay off the employees, for example, those who are taking home huge salaries for less job, especially the management. And then the last one is reducing capital spending on research and development. So they have to cut on some of the expenses that is not a must. See, the reason why we employed you is because you are qualified. Why should we invest more money in capacity building? So we terminate the budget for capacity building, etc., etc. So if this is the case, or if you are financially distressed, how are we going to predict that you are financially distressed? We normally use 3 models. We have the Altman Z-Score model, you have the Beavers, and you have the Zetal model. At this level, you'll only use the Altman model. Beaver and Zetal model is for advanced stage. So for those people who will coming back for their masters, we'll be using the Beavers and the Zetal model at the master's level. So let's look at the Altman Z-Score. Now, Altman Z-Score is a common method or common model of predicting the corporate failure. It was developed by this guy called Edward I. Altman in the year 2000, in the year 1968. And it's a good model. Well, it has its cons, but this model was able to predict correctly at 95% degrees of confidence the 2007 financial crisis that hit America. So they had indicated that we are going to get the financial crunch at a median of 1.8. And that's how it became famous. So the Altman Z-Score model I'm trying to present the model itself without necessarily complicating issues, but the models look like this. Can see the model. Are you able to see the model? Are we able to see the model? Yeah, I can see several S's. I was managing there was a choir behind me. So I think we are now better. So the model is there. We have 1.2x1, 1.4x2, 3.3x3, 0.6x4, and then we have 1.0 or 1x5. Now these are metrics, or these are actually ratios. I've said that the Altman's model was done with a lot of sophistication because Altman selected a sample of 33 companies, and he used this to test this score until it worked. The score has been merited by and large. And when we are talking of the X1, have another character. Opari Makoha should be civil. These are class. So we go on. I was explaining the X1, the X2, the X3, the X4, and the X5. And I've said that these are ratios. And the different ratios, like the X1 is the working capital over the total assets. So we normally say that a firm with